Institute's president, and it's my pleasure today to introduce and host our semi-annual Global Economic Prospects event led by non-resident senior fellow Karen Dynan. As many of you know, and I hope our regular viewers, we publish our somewhat informal, but we hope still rigorously thought through forecasts for the major G20 economies semi-annually in April or March, end of March, and late September, early October. We time it to be just ahead of when the IMF issues their World Economic Outlook. So we're not criticizing them, we're independently giving our views. And we draw on the expertise of the entire Institute staff to make our views best known for the growth outlook for the world. Karen has been leading this for us since, I believe, 2017. Previously, David Stockton and Michael Musa played this role. And we feel we make a pretty good record of calling turning points and policy mistakes in ways that our independence allows us to do that official sector forecasts and some financial sector forecasts may miss. Doesn't mean we're always right, obviously, but we've been pretty good on a number of the big issues over the last few years. Today, as ever, we're having two thematic deeper dives to go with the global and US outlook that Karen will present. We're joined today by Anna Gelpern and Jacob Kirkegaard, two both long-term colleagues of ours at Peterson. Let me formally introduce each of the speakers in that order, and then we will turn it over to Karen. So Karen Dynan, just to be clear, is not only a non-resident senior fellow at the Peterson Institute, she's a professor of the practice at Harvard University Economics Department and teaches at Harvard's Kennedy School. She served as Assistant Secretary for Economic Policy and Chief Economist at the U.S. Department of the Treasury from 2014 to 2017. And previously, from 2009 to 13, she was Vice President and Co-Director of Economic Studies at Brookings. She'd previously done seminal work on household finances, on savings behavior, on macroeconomic forecasting while on the staff of the Federal Reserve Board. Speaking second is Anna Gelpern. Anna has just been named the, I believe, Scott K. Ginsburg Professor of Law and International Finance at Georgetown University Law Center. She's been a non-resident senior fellow at the Peterson Institute for, I think, more than a decade now. She is perhaps the leading person integrating international law, debt, and economics. She has led efforts in the now annual DebtCon conference, as well as on the law and economics from a very different perspective than the previous use of that term. She's been an advisor at the UNCTAD, at the IMF, at the US Treasury, and previously served in the US Treasury during the Clinton administration. There's too much to talk about, but some of you will remember we hosted Anna for a talk about her and her co-authors' work on Chinese debt contracts. Today, she will be addressing the real-time issues of the banking, I'll call it non-crisis in the US right now. Finally speaking today is our colleague Jacob Funk Kirkegaard. Jacob now is based in Brussels, where in addition to being with the Peterson Institute, he's a senior fellow with the German Marshall Fund of the United States. In work for them, he notably contributed to their proposal for a Marshall Plan for Ukraine for post-war reconstruction. We hope we will get to see the day. Jacob has worked for the Institute since, I believe, 2002, and covers a wide range of issues in political economy, European political affairs, European economic policy making, as well as longer-term work on demographics, including a notable paper that he, Karen, and Anna Stansbury authored last year on Korea's demographic decline and its implications. And Jacob will be talking today about the surprisingly resilient European economy. So with that, please let me turn it over to Karen. Thank you, Karen.
Thanks very much, Adam. I am going to share some slides. Hopefully people can see that. Let me just sure my screen is arranged. Okay, so thank you for that introduction. It's a pleasure to be here with this distinguished group of panelists. To preview where I'm going, I think the most likely outcome we'll see is below trend global growth over the next 2 years, rather than recessions in most countries, but that there is negative tail risk. So, to set the stage, the incoming economic data has shown more resilience than expected. The slowdown in demand in the United States is limited as yet. Europe looks like it has dodged a recession. As Adam said, Jacob will be making the case after me that the fundamentals there are still quite solid. China is, of course, rebounding, and lower oil prices are supportive of growth everywhere. And inflation looks like it's peaked in many countries, not all countries, but in many countries, as you can see in this graph. The US is in blue, other advanced economies are in pink, and emerging market economies are in gray. So it looks like it may have peaked, at least so, as yet, but it's still at very high levels. And that means continued restraint from monetary policy. The big development of late, of course, has been the bank crisis. And of course, Anna's going to be talking about that after me. But from the perspective of the forecast, it has increased uncertainty. All else equal, the banking troubles are likely to lead to tighter credit conditions as banks respond to the outflow of deposits, stricter supervision, and possible regulatory changes. The extent of this tightening is difficult to measure and predict. And while my best guess at this point is that it will induce only a modest additional drag on economic activity, I think the potential for further turmoil poses some negative tail risk. Financial conditions had, of course, already tightened considerably prior to the bank panic. And you can see that in this chart. You can see the big hikes in interest rates by many central banks in the left chart here. And on the right, you can see the fact that long-term government borrowing rates are high by pre-pandemic standards. If you look at the far right side of the right graph, you can see that government borrowing rates have declined a bit since the troubles in the banking system began, but these movements have only reversed a little of the earlier rise. Financial market indicators of risk are also up in recent weeks. As you can see on the left here, the US corporate BAA spread has popped up. So clear movement there on the bank panic, although the current level is not out of line with what we have seen for much of the pandemic. And as you can see on the right, there has been some retreat in global stock market indexes. So altogether, I'm expecting that global growth this year will fall short of last year's pace before picking up a little next year. And the main limiting factor on growth in most countries is the tighter financial conditions. I should say, this is a stronger forecast than I showed last fall. And that's owing to the surprising strength of demand and the resilience of economies that I discussed earlier. And I'll have more to say about that when I cover the US. In terms of the large advanced economies, as I said, I'll talk more about the US in detail in a minute. Jacob will explain why the European outlook is brighter than it was a few months ago, although in both cases, we're looking at below trend growth, again, because of the tightness of financial conditions. Japan is the only large advanced economy that I see growing at its potential pace this year and next. And that's because of the limited rise in inflation in Japan. So that means limited monetary restraints. And also there's some fiscal support that matters for Japan as well. Meanwhile, the UK is the economy lagging among the group. The UK has been struggling with inflation pressures. It's one of the economies where it looks like core inflation is still on the rise. And our expectation is that generous public wage settlements later this year are going to be an additional inflationary shock that the Bank of England will need to deal with. And for that reason, we're showing a pretty pessimistic outlook for the UK, although we're not talking about a major recession, just a stalled economy. So then turning to the emerging market outlook, it's more divergent than for the advanced economies. As I said earlier, China is, of course, rebounding. That's both on the earlier than expected reopening after COVID, but it also is from a fading drag from the property crisis. Growth prospects for India, they look pretty solid, and that's what we're seeing in the data coming in from India. We think their progress in economic reforms have helped support economic activity. But the outlook for the Russian economy is poor, as it has been for some time because of fallout from the Ukraine invasion. And Brazil is struggling with high interest rates, and they continue to struggle with ongoing structural problems. So this table here just summarizes the outlook for the various large economies. I will now turn in more detail to the United States. You can see the ongoing strength of demand in labor markets on the left. Job growth averaged 400,000 in the first 2 months of the year. And the unemployment rate, which I'm not showing, but it is very low. It remains close to a 50-year low. Housing activity, which I'm also not showing, it's down as expected, given the higher interest rates. But you can see on the right in this chart that consumer spending has remained fairly robust. And I'm not sure we should be surprised by this resilience. Consumers still have pent-up demand left over from the pandemic. You certainly know that if you've tried to buy a car recently, but you can also see it in services on the right side of this graph. The level of services, it has room to grow to get back to its pre-pandemic trend. But on top of that, people are making up for services they missed. Travel, still very, very strong, and healthcare is also a category where people are making up for lost ground. The left graph speaks to how consumers, at least in the aggregates, still the wherewithal to finance pent-up demand. You can see the shortfall in saving since early 2022. It's been below trend, but that's only used up a fraction of the excess saving accumulated earlier if you compare kind of the amount since 2022 and the amount accumulated in the couple of years before that. I will flag that it no longer appears to be the case that financial buffers are high across the income distribution. Various indicators are now showing more cracks at the bottom, but in the aggregate, it looks like there's money to spend. Labor demand is easing, but only slowly. As you can see from the limited reversal in job openings per unemployed workers on the left, you can see both the official series from the government, but also a series based on Indeed job postings. You can see some series pandemic peak in blue, and you can see the dates of those peaks. Some of the biggest improvements in terms of reduced tightness in the labor market are in the sectors you would expect. You can see IT, big drop in job openings. So IT, of course, includes tech. You can also see a drop in job openings in real estate and construction related to higher interest rates. But the chart also shows acute ongoing shortages in healthcare and in leisure and hospitality, underscoring this point that labor market pressures have only eased a bit. This chart shows you a little more detail about US inflation. Looking at the core measures I'm showing on the left, I think there's a good case that we're past peak inflation for now. And I should say this set of core measures that I have here, the most timely information comes from the 3 months change, although that series tends to be more volatile because of the 3 month change. If you look across this kind of suite of alternative indicators of underlying and fresh inflation that people have developed over the past few years, you'll also kind of see the same sort of pattern. High inflation, but it looks like we've peaked and inflation's coming down a bit. The right chart shows you that goods inflation has fallen sharply, but that services inflation remains high. So with inflation moving in the right direction, but still really high, I think the Fed is going to need to make a couple more hikes and probably not be able to start reducing rates for at least another year. My best guess is that the exogenous tightening of financial conditions that is stemming from the bank panic has done a bit of the Fed's work for it, but I don't view it as a full substitute for the work the Fed needs to do, both because of the limited magnitude of the effect on the economy, but also because it falls on the economy in a way that will be somewhat different. So I think this all adds up to growth that is short of trend. Basically what I'm forecasting is a slog, but not a recession, as I show in this chart. Just kind of flattish growth this year, and then a pickup to a still below trend rate next year. Okay, I should say this is a more optimistic outlook than I had 6 months ago. 6 months ago, I thought the odds were greater than even that we'd see a mild recession this year. That's not what I'm forecasting anymore. And that's because we've seen the resilience I talked about earlier, but it doesn't look like that extra demand is pushing inflation up further. Besides the numbers I showed you earlier about inflation peaking, I wanted to show you that inflation fundamentals look pretty good. So I mentioned the decline in oil prices earlier. The left graph here shows a big scaling back of supply chain pressures. You can see they're about back to normal. And the right graph shows still contained inflation expectations. They're up a bit for sure. But if you look at this series, certainly they're low relative to where we were in the late 1970s. But even if you look at kind of the history of these various series going back to earlier in this century, you can see the current levels are not all that high. And just in terms of kind of where the labor market is, I think there has been good news and some less good news on the supply side of the labor market. On the latter, the less good news is that I think participation looks like it's probably peaked. You can see on the left in the top panel that prime age participation is back to its pre-pandemic highs. It's not clear how much further we should expect it to go from there. And then on the bottom, you should see older workers are just not coming back. And I should say that's not totally a surprise. The older workers, that group is older than it was prior to the pandemic. There is aging within the group because of the aging baby boom. And so it's not clear it's that much of a puzzle that the labor force participation has come down and stayed low. But I don't know that there's a lot of room for it to increase again. On the right side, you can see the better news on labor supply, and that is that, for a while it looked like restricted immigration was really holding back labor supply, and it didn't seem like the immigration trend was turning at all. But really, over the last year, we've seen this kind of big increase in immigration, which is bringing it back to its trend, and I think that will help relieve pressures in the labor market. Here is where I come out on the most likely scenario for unemployment and inflation. Because of the below trend growth, the unemployment rate is likely to rise by about a percentage point relative to where it is today. Today it's around 3.6%, and my forecast, my baseline forecast at least, has the unemployment rate rising to 4.6% and staying there. I think inflation is headed down, and that is what the Fed is trying to do. So I think inflation will come down, but not as quickly as some people are forecasting. So I've written down a 3.9% increase in core PCE for the 4 quarters of this year, which you can see is about a percentage point below what we saw last year, and then 3.2% for the 4 quarters of next year. So I think we'll get into 2025 and we'll still have some more kind of work to do in terms of getting inflation down to central bank target. And then for my last slide, I just want to come back and emphasize that the forecast that I have presented, it's my modal forecast. It's the most likely outcome. I don't think the risks are balanced. I think the risks tilt to the downside. So regarding the bank panic, there's a good case for why contagion will be limited, given the idiosyncratic business models of the troubled banks. They really did look fundamentally weaker than the rest of the banking system, as well as the vigorous policy response. But I can't help but think back to previous financial disruptions that we thought were contained that later turned out to be much more serious and much more pervasive. So here I'm thinking, for example, back to the summer of 2007, when people were saying mortgage crisis, it's contained in the mortgage sphere, seeing a little spillover to the broader financial system in August of that summer. But we think it's kind of an isolated thing. And these recent developments, the downside risks associated with these recent developments are all on top of the intrinsic difficulties of achieving a soft landing when there really is a lot of uncertainty about transmission lags of monetary policy. And there's a possibility of unforeseen shocks, including further inflationary shocks. So that's where I will leave things. Now I'm going to turn things back to Anna Gelpern. So Anna.
Thank you very much, Karen, and thank you, Adam. It's great to be here. I am not in the forecasting business, so this will be more of a take on where we are in the banking event. I guess echoing what Karen has said, I do think that the banking crisis headlines obscure more than they reveal. There are real differences, very dramatic differences among the banks that are in trouble and those that have failed and those that remain. It doesn't mean that there are no vulnerabilities. It doesn't mean that we're not worried about the credit supply or the flow of deposits from smaller banks to big ones and the inflows into money market funds. But all that to say, there is no reason so far to suggest that there is a banking crisis. There's every reason to think that there are some very badly managed and terribly supervised banks that whose failure has spillover effects. Now, just pulling back from first principles, all banks have, by definition, illiquid assets and demand liabilities. That's what they do. They're inherently fragile, and you would expect them to have to adapt to rising interest rates. Again, that's what they do. That's why there's a safety net for the banks. That's why there is that's why there's deposit insurance for depositors in failed banks. And that is why there's intrusive regulation and supervision, at least in theory. Interest rate risk is a perennial. Technology is a perennial risk. Savings and loans, were hit by technology shocks, right, in the 1980s and 90s. Now, what was different here? Silicon Valley Bank was by far the fastest growing bank in the country. It was 16th when it failed. In 2018, it was 37, right? So this was an unusual instance of a huge influx of deposits and very fast asset growth in a world where simultaneously we had weakening supervision along many dimensions. Now, really, to me, the big question here is why would the failure, or why would troubles in two niche banks with immensely concentrated deposits and just very distinct business models would be seen by the US authorities as a systemic risk, so much so that 2/3 of the board of FDIC, 2/3 of the Fed, the Treasury Secretary, with the president determined that their failure would present a risk to the financial stability of the United States and warrants extraordinary measures. I think that what we see here is, first of all, as I mentioned, tremendous supervisory failure. And I do think that supervision is the focus, because no amount of kind of bright line rules would necessarily expose the kind of concentrated business model. The fact that just a handful of individuals had uninsured runnable deposits in this institution. I do think that, again, this is something that is that we have to really look at, but also, supervision through the cycle, right? Like the whole point of the revelation of, Dodd-Frank and the idea of, macroprudential supervision is precisely to consider, the time varying risks and responses, right? And this is something that clearly we fell short on. There have been warnings. Warnings were ignored, or the response wasn't quick enough. What we have learned is that the emergency response that the Fed and FDIC are able to mount, both for individual institutions and for the system as a whole, are brisk and big, and certainly can rise to the occasion. I hesitate to call it routine, but there's certainly been a learning process that I think gives us a lot of confidence in the system's capacity to respond. But there are two big problems with this overwhelming response, which again, I wouldn't second guess necessarily, but one is it raises the question of what is it that we don't know, right? You have these very unusual institutions, the uninsured deposits at Silicon Valley were 89%, and in peer banks more like in the 50s, right, or 40s. So it's a really unusual institution. What is it that made it systemic? And then the second one that's really troubling, the second aspect of the response that's troubling to me is that if there is a panic with all the rules priced in, then the overwhelming response necessarily entails rule breaking and undermines regulatory credibility going forward. So in sort of reassessing and re-regulating and re-supervising after the fact, we're not starting where we left off, we're starting at the bottom of the hill. And that is, to me, disconcerting. It bears watching the move of deposits to money market funds and to larger banks. That's not great, and that's certainly, I think, something that bears watching for financial stability, from the financial stability perspective. And I do want to ask, where is the Financial Stability Oversight Council in all of this? This is, FSOC is the acronym we really have not heard much. And I think we should hear a lot more of, particularly as cash moves around the system as liquidity sort of moves elsewhere and out of smaller banks. One word on Credit Suisse. Again, there is, to me, no apparent reason to connect the troubles at Silicon Valley and Signature to Credit Suisse. There again, the troubles at the institution have been known for a very long time. And the authorities' response is what it bears kind of watching. It may have more lasting consequences. The wipeout of additional tier 1 instruments looks like was just fine under the contracts. However, that doesn't answer whether this is a sensible regulatory construct. And to me, the credibility of these hybrid instruments, whatever the contracts say, is a question that regulators will have to struggle with. And I think that they would have to look at exactly which institutions have these kinds of covenants. And I am not necessarily copacetic with just regulatory statements before I see more detailed information about this, which I'm sure will come out. So with that, thank you. And Jacob, over to you.
Well, thank you, Anna, and thank you, Adam, for having me back. Here is always a pleasure to join. I'm just going to share a few slides here, and off we go. Hold on. Yep. And basically, as Adam mentioned, my topic will be really why the European economies have proven pretty resilient. And just to preamble my main points, I think a lot of it has to do with the fact that in hindsight, I think it's pretty clear that Europe exited COVID arguably best in class. We've got historically strong labor markets, which will be a source of household support going forward. Corporate profits for a region that has suffered a dramatic negative economic shock is actually quite resilient. And probably most importantly, the energy price shock that we saw at the outset of the Ukraine war has now, in my opinion, at least fully abated and is highly unlikely to return. So ultimately, while certainly the ECB has now conducted a non-trivial monetary tightening and will keep tightening a little further, we are nonetheless in a situation where the combination, or you can say both macro policies, will pull in the same direction, because I foresee, partly related to the decline in energy prices, also a marginal tightening of fiscal policy this year. We are in a position where inflation levels in Europe will come down very rapidly. But just starting with the starting point and how Europe actually got out of the COVID pandemic. Well, as I said, I think basically the EU has been best in class if you compare with other major economies. I think it's pretty clear that the wage subsidization model that Europe adopted proved superior to the hire and fire that we saw in the United States. You did not have a similar type of labor market shock, and certainly the reopening for that reason in Europe has proven far more, if you like, immaculate than has been the case in the United States. Similarly, you do not have any material long COVID effects in Europe, certainly not any that has any labor market implications, indicating that the overall health situation of the labor force was maintained in a very protected manner. And then finally, as the chart here shows, ultimately, the fiscal outlays, while certainly very counter-cyclical by euro area and EU standard compared to the global financial crisis, were, I would say, at an appropriate scale and obviously considerably lower than either in the United States or ultimately over time in China. And therefore, you did not have the buildup of domestic inflationary pressures as a result of that either. This has indication, as I said, I think the labor market COVID policies in Europe were very, very well designed. Perhaps it was luck, but nonetheless. And this has basically meant that while we just heard Karen say that participation in the US may now have peaked, we don't know if it has in Europe, but we certainly know that it is at record high levels. It is up, almost a percentage and a half from its already, by historical standards, very high pre-pandemic levels. And we also have hours worked, meaning that the sort of short-term, part-time subsidized working models that was adopted across Europe no longer lowers aggregate hours worked. So again, labor markets really is at a historical strength throughout the European Union, something that, of course, in countries with large welfare states also have in a number of countries, non-trivial positive fiscal policy contribution, at least on the, if you care about the Stability and Growth Pact and those set of issues, on the structural level of deficit across the EU. On the other hand, you might say, well, strong labor markets, historically so, means we should worry about price-wage spirals, etc. And it is certainly true that Europe have suffered, in fact, the opposite of a price-wage spiral, I would argue, because we've had very dramatic declines in real wages after mid-2021, when the energy price shock began to materialize. But at the same time, certainly if you believe the ECB's forward-looking wage tracker, we're not looking at a price-wage spiral. The ECB projects about 5% nominal wage growth for 2023. It also projects, as we will see later, about 3% inflation by year end. That's 2% real wage growth. That's about a third of the decline of the last 18 or the last 18 months during the war. That's not at all a price-wage spiral, but actually very prudent, I would argue. Now, you might say that there are some labor unions, transportation unions, like, for instance, we saw the big strike in Germany yesterday. They will push for more. There's no doubt about that. But I guess I would contend that while in many ways it's positive that workers demand higher wages in a generally tight labor market, they're not likely to be representative of the overall wage demands. So again, overall, I would say wage demands, as I say here in the euro area, actually are very prudent, given the negative shock we saw in 2000 up until the beginning of this year. Same story on corporate profits. Obviously, the United States is right now seeing record high corporate profits. That's not the case in Europe, but we're back to trend. Or the pre-pandemic and pre-war trend, and I would contend that's not a bad place for the euro area to be at all. And it would certainly suggest to me that there's no reason for the corporate sector to delay hiring or stop hiring or lay off workers when you still have relatively resilient profit rates, and therefore I would certainly predict continued labor market strength. Most importantly, perhaps, we now have a very dramatic decline in natural gas rates. We're now basically back to a level that's only about a quarter higher than what you saw in real terms before the pandemic. Also caused natural gas prices to decline, as you see in the chart here to the left. And I don't think there is much of a risk of this returning. And perhaps more importantly, neither do forward markets, which you can see here by the red dots. So actually, all the talk about deindustrialization, etc., demand destruction in Europe, I think in some energy-intensive sectors, it is real. But I think it has more to do at this point with what really looks like the true permanent energy price shock experienced in Europe over the last couple of years, which is namely the rise in the carbon price, which is now nearing 100 euros, as you can see on the right, and according to the forward markets, again, continuously expected to rise in the years ahead. That is something that energy-intensive businesses in Europe are already addressing. And just a quick word on inflation. What you have here is the ECB forecast for the euro area from a couple of weeks ago. As you can see, a very dramatic forecast decline to just below 3% at the end of 2023. I would actually argue that there are good reasons for why this forecast is too pessimistic. The cutoff date is February 15th. That means there's no inclusion here of any of the volatility in the banking sector, which I certainly believe, while I agree with Anna that I don't think it will have macroeconomic implications, but directionally, it does also in the euro area tighten overall financial conditions. But more importantly, the assumptions put in this forecast about energy prices are already significantly out of date. Both natural gas and oil prices have declined, between 15% on the oil and up to 30% by year end on natural gas. So we could actually expect, therefore, the decline to be even more pronounced than what the ECB forecast. This is true also for wholesale power. And this is also important going forward because the bump you can see that the ECB forecast in 2024 is entirely related to the expected phase out of public policies aimed at controlling energy prices, which is basically assumed to expire at the end of 2023 in this forecast. Well, if energy prices keep falling, there's no real reason, in my opinion, to expect that there will be a bump up in headline inflation from this withdrawal of policy measures in 2024, which, as I said, overall leads me to conclude that if anything, this ECB forecast is likely to be upward biased given events we have seen since it was produced. Finally, a quick word on the war in Ukraine. I've already talked about, I think the energy effect of the war are gone. What we clearly know, no matter what the outcome of the war is, we're going to have a long-term permanent increase in defense spending across the EU. I would, back of the envelope, predict it to be about 0.5 percentage point a year, possibly more. We also know that whenever the war ends, there will be a significant reconstruction bill. This is overwhelmingly likely to be paid by the EU, which certainly, in my opinion, will have also implications for fiscal integration for the EU, which in some ways is a structural supply shock for the entire EU institutional architecture and also the economy. And then finally, of course, in the long run, the inclusion of the Ukraine in the EU will require a far-reaching institutional change within the EU, but also include in the EU a very large country with very, very low wages, which should, in the case of Ukraine, therefore expect significant catch-up in the medium to long run on economic growth. And those were my words. Thank you very much.
Thank you, Jacob. Thank you, Anna. Thank you, Karen. As our regulars already know, and I should have announced up front, we are taking questions from registered participants on the Q&A function on Zoom. I will lightly curate. First up, for Karen from Howard Schneider, why is a 1 percentage point increase in unemployment consistent with the call of no recession this time? Are the unemployment dynamics different this time?
Yeah, sure. So just to remind folks, I have the unemployment rate in my forecast. This is for the United States, going up to 4.6% from 3.6% where it is now. To the question asked, what we need to hold the unemployment rate steady at its current level is the economy growing at its trend pace. So I would put trend at a little less than 2% right now. What I have in my forecast is the US economy growing more than a percentage point below its trend rate this year, and about half a percentage point below trend next year. So the kind of normal relationship we expect between these two variables is captured by something called Oken's law. But if you kind of apply that to the kind of shortfall in GDP we've seen, particularly taking into account the fact that growth was also below trend in 2022, it fits kind of this path of a 1 percentage point rise in the unemployment rate well.
Great, thank you. Anna, I'm going to group two questions for you. From Peter Coy, he says, I grant that supervision failed, but why do you say that bright line rules would not have caught SVB's dependence on uninsured deposits, excuse me. And Joe Gagnon raises the most obvious risk to the banking system since 2009 is exactly what brought SVB down, a sharp rise in interest rates. Did the Fed not see the scale of the problem, or is there a fundamental inability of supervisors to enforce behavior? So Anna, if you could respond, please.
So these are both great questions. And Adam, I'm glad that you raised them together, because I feel very strongly that they have to be addressed together. And one way to look at it is this: the bank's liquidity coverage ratio, which was sort of the bright line rule from which it was exempted by regulation and in the aftermath of 2018 legislation, it was great. The reason its liquidity coverage ratio was just fine is because the underlying assumption was that retail and small business deposits do not run off, even when they're uninsured, and that U.S. Treasuries can be sold at full face value, right? So it's, yes, if we had calibrated the bright lines the way we would now in retrospect, certainly it would have worked. The problem is that they weren't calibrated this way, and the dynamic character of the banks and banks in this area in particular really puts the onus on supervision. Now, this does not mean, again, that if the full suite of regulatory measures had applied to the bank, and if the stress tests were properly cognizant of the full range of risks, that some bright line wouldn't have picked up this particular problem, right? But really, other banks have uninsured deposits. Other banks have, hold to maturity, unrealized losses in their hold to maturity books, right? The business model here was incredibly vulnerable, is a very polite word to put it. And Adam, if you would allow me just one more point, which is that there's a lot of focus on 2018 legislation and 2019 regulatory relief that sent a very powerful signal to the banks between 100 billion and 200 billion in assets that, it's time to take a deep breath, step back and relax. And there was an enormous amount of growth and consolidation in that segment, right? And even the year before in the regulatory review, there were specific comments about how stress test scenarios were much too pessimistic, right? So if you take the combination of that, right, regulation, supervision, guidance, legislation, and then look at the business model, these two combinations gave you the toxic mix that we saw implode. Are there vulnerabilities elsewhere? Quite possibly, but I think that static bright line rules would not necessarily pick them up.
Thank you, Anna. I'm going to gather a couple questions for Jacob, but then circle back to Robert Schreers with a question for Karen. But just one note, our Peterson colleague, Patrick Honohan, posted, I believe yesterday or the day before, no, yesterday, a graphic, a PIIE chart talking about the failures of the US stress tests to account for or take into account interest rate hikes, which was a pretty egregious failure in addition to the list that Anna mentioned. Patrick was, of course, the governor of the Central Bank of Ireland that was in charge of cleaning their mess up. So I would urge people to take a look at that. Jacob, combining two questions, we have a question from Andre Almeida. You know, what you have this very positive outlook. What do you see as the main risks to the outlook, downside risk for Europe? And an anonymous attendee has said, what's the scenario for reducing Europe's dependence on energy from Russia? So if you could briefly respond to both of those, because I want to get in another round of three.
No, I mean, the second question first. Well, there's no scenario really. It's already done, quote unquote. There is now a ban on oil imports from Russia to the EU. Yes, there can be smuggling through third countries, but effectively Europe is now independent of Russia on the oil side. There's still an import, if you include LNG from Russia and some gas through Ukraine, of about 10% of natural gas from Russia. This would obviously, if you were to cut that off, you could. Remember, this is not sanctioned. The EU could choose to do that. That would require importing even more LNG, and I think would be marginally upward pressure on prices. But in effect, the scenario has already been implemented. De facto, as I think I wrote on one of my slides, Vladimir Putin has no blackmailing options on Europe through the energy supply anymore. My main downside for the European economy is, as I said, I think the ECB is already in tight monetary policy territory for Europe. I think if we get a continuously hike of well above, say, 150 basis points more because there is some sort of complete hawkish takeover, I certainly think that's a downside risk. I think it's low, but it's a downside risk. We still have a war in the immediate vicinity of Europe, and while I am very optimistic about the prospects for Ukraine during the war, it could escalate and it could spill over into other parts of the European territory. We should not rule that out. Then we have at least one important election in Europe in the coming 6 months. That's Poland. That could get very messy. With a government that may not want to withdraw from power voluntarily. And of course, we have the upcoming election in Turkey, which could make it more complicated to maintain the deals between the Erdogan government and the EU on immigration and other issues. But overall, I don't view my outline as actually particularly tilted to the downside. Thank you.
Thank you, Jacob. Turning back to Karen, but anyone can pipe in. Robert Schweers asked, what signposts would you be monitoring to see if a deeper financial shock and downside macroeconomic scenario is emerging? And we do have a couple other questions on the chat that are related, including how big is, you think, the drag or the substitution for basis points of hikes, the current credit tightening is. But if you could just focus particularly on what you're watching for, sure, that would indicate that the credit crunch is more serious than what we've put out.
Sure. So I will just quickly speak to the latter thing that you raised, which is I'm in the view, and this is kind of my best guess, there's a lot of uncertainty, that kind of what we've seen so far is modest, on the order of kind of 1 to 2 Fed tightenings. That's the way people are expressing these things. So in terms of what I'm watching, and this really is an essential question, because remember the thing, even after we knew we were in all this trouble in 2008, if you looked at macro forecasts, they weren't showing much impairment to the economy. And that's because people were not focused on kind of the credit shock, the bank panic effect. So it is essential that we're watching this situation. I think first and foremost, flows of credit. Watch bank lending, certainly, but also what's going on in broader capital markets. So I think that's one thing, because it's just essential to the functioning of the economy. If you want to get a little more forward-looking, I would look at, or I am looking at bank losses, and as well as forming expectations about likely bank losses, given what else we know is going on in the economy. There are real reasons to worry about regional banks, for example. They're very exposed to commercial real estate, and the pandemic has hit that sector very badly. House prices were up an astonishing 45% at their peak in the pandemic. They're starting to come down a bit now. I think at this point, there are reasons to be more sanguine about that than we were before the financial crisis, because I think some of the rise looks like it is fundamentals related to preference shifts, related to work from home. Although I don't know that that's all of the rise by any means. So I think there is some bubble in there that's going to be coming out of house prices. But the more important factor is there's more kind of people have more equity in their homes, so they can withstand a larger shock, which means they're not going to be so happy if their home prices decline. But it means not big losses for the banks, as we saw in the global financial crisis. Yeah.
Thank you, Karen.
Yeah.
Without disrespect to Jacob, I'm going to give Anna the last question. There are some very good questions about China, the impact of trade conflict on growth, on lending, also deeper questions for Karen on the NAIRU and on inflation expectations. We'll ask you to follow those up directly with the authors. I apologize, we can't get to everything. For Anna, from Rick Newman at Yahoo Finance, to what do you attribute the supervisory failures regarding the banks? Are the regulations sufficient, the supervisors simply not enforcing them? Or did the deregulatory efforts under the Trump administration, both congressional legislation and Fed policymaking, weaken supervision?
I certainly think that the former is the baseline and the latter is the amplifier, right? So I think that we always find out in every crisis that there was an element that we missed. But I think that we're way more likely to miss these kinds of risks in a world where supervisors tell banks to, call Washington if your bank examiner is being too strict, right? I think that we are way more likely to miss these kinds of risks in a world where, we're expecting, or we're looking at stress scenarios for being, too pessimistic and too unpredictable, right? So in a world where that, those are the signals, I think both the behavior of regulated institutions and the behavior of supervisors changes. And I think this is where we get, this kind of risk. And I think that we really have to, see what turns up in terms of the supervision record. But I think that we really have to look hard at our ability to regulate through the cycle. Thank you.
Thank you. If I may editorialize for a second beyond my deep thanks to Jacob, Karen, and Anna, 2 points with regard to this banking system issue. The first is I view this as very close to the savings loan crisis, which Anna mentioned. In that you have a bunch of banks in the mid-size range that are structurally unsound in their business model, who get a regulatory and supervisory carve out because local politicians, including senators, like having those banks. And the rest of it, to me, is kind of specifics that don't matter as much. And so I think this proves the point that regulation and capital do matter, that the smaller banks and the systemically important bigger banks have not suffered in the way that these banks did. And what we need is more effort to get us to a barbell-shaped distribution of banks, that there are big ones and small ones and not these ones in between who have, frankly, an uneven playing field and abuse it. But the second point, linking this back to Karen's response, is that means that a larger part of our banking system is well capitalized, is well supervised than it was in 2008. And if you don't believe that household balance sheets and bank balance sheets matter and supervision matters, then you have a very strange view of what determines financial fragility. And to me, if anything, SVB and Signature prove the point that where we don't do supervision and where we do pander to Congress and give a regulatory carve out, that's where the vulnerability comes. So that's why each of us speaks our own views on these global economic prospects, as you know, but that's why I'm largely where Karen is and Anna, that I think there is resilience there this time that we did not have last time, even though the supervisors did screw up. With that, thank you all for attending. Please feel free to follow up directly with our speakers, Jacob Kirkegaard, Karen Dynan, and Anna Gelpern, for those of you whose questions, unfortunately, we didn't have time to get to. Also, feel free to contact our Director of Media Relations and Strategic Communications, Michelle Heller. We will look forward to doing another one of these in 6 months. And ideally, not just because we like to be right, but we like good news. Ideally, Karen, and all of our forecasts, including Jacob's for Europe, will turn out to be true. Best regards, everyone.